Well, that was an interesting trading day. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually beautifully sunny Redmond, Washington. The weather in Redmond, Washington, a complete, differing trend from what we observed in the major market averages today. Welcome to the show. Thanks so much for joining me here on the live stream. Those of you that are doing so, and if you're watching the replay on our YouTube channel, I appreciate you doing so as well. A lot to unpack today. I'm going to try to keep it to our normal period of time. We may go over a little bit with the number of charts. This is one of those times where I feel like the number of charts to really reflect on and try to make sense of what's happening. There are quite a few I'd love to show you. In the interest of time, I'll do my best to keep it concise and focus on the most actionable ideas. So here's some high level thoughts just as we go on. Number one. Not a surprise. Hopefully, if you've been watching the show and following our content, we've been talking about so many defensive rotations that we've observed. While I would not have maybe picked the S&P down 5% today, on April 3rd, which happens to be my birthday, by the way. So happy birthday to me with this kind of awesome market action. People that know me and know what I do and know my birthday, that was the general trend in my text today was, market gods showering on your birthday kind of thing. And that's fine. We'll still find reasons to celebrate after the show. But to put things into context, right? I mean, we've seen these signs of distribution. And I think what you have to remember is, as we've mentioned many times, you think of the market as bullish or as innocent until proven guilty, or guilty until proven, and I almost said Guinnessy, so that shows you where my head is at after today. Innocent until proven guilty, or guilty until proven innocent. I think we've made it very clear we've been more in the guilty until proven innocent, frame of mind for pretty much the entirety of 2025, but especially here since February, when the market's making new highs on weaker momentum and weaker breadth, and that seems to be just the beginning of the distribution that we've seen. Now, to be clear, there are plenty of things that are up today. There are plenty of things that are up year to date. There are plenty of things that are up this week. And I'll say it again, there are plenty of things that actually look fine from a technical perspective, if not absolutely great. I'll show you a couple charts here at the end of the episode in our chart review that are in primary uptrends, that are in making higher highs and higher lows. So I think the beauty of technical analysis and of charts is if you know what you're doing and if you have a consistent process of looking for constructive patterns and improving relative strength characteristics, you're not going to struggle to find things. Like I'm finding things today that look pretty decent. What does that mean? I mean, and I think the challenge though is how do you allocate to those ideas? And that's where, to be general, as we've talked about, since our market trend model turned negative, we've been very much on a get out of the way of the market, be defensive, get in stable assets, low volatility assets, higher income assets, things still going up like gold, and just trying to ride things out. And that on a day like today, there are very few things better than essentially being on the sidelines and being defensive and watch the market go down. Now, to be clear, I mean, I think the breadth conditions were fairly weak, but there are types of stocks that are going to do okay in this environment. It's things you need. The two top performing sectors today were consumer staples, which are things you kind of need that you're going to get in any market environment. It's utilities, talking about powering your house and things like that, which you're probably going to want to do in any environment. It's healthcare, because when you get sick, you're probably still going to go to the doctor, although it's pretty expensive and maybe you don't. But overall, that's kind of a general assumption. Stable, low volatility parts of the market are kind of doing fine. So friendly reminder, the market is not the Magnificent Seven stocks. Those stocks and big multinational companies are having a big hit today. We will go through all of those and review them, but there are things that are doing okay. And that is my optimistic, it's going to be okay announcement for you. Kroger's going up. It's not going down. It is literally going higher. So focus on areas, use charts to your advantage and focus on charts that are trending higher, particularly on a relative basis. All right, with that as my soapbox introduction, let's get to the charts. And again, if you like the color red, you're really going to enjoy the show today because there's a lot of it. The S&P 500 closing down 4.8%. That's just below 5,400. So I would say safe to say that our downside target of 5,500 now broken. As far as I'm concerned, that makes a clear path to our eventual downside target, which I'll share with you when we get to the chart review portion, but it's lower than we are today for sure. And again, not to get too political and too, macro, because my goal with this show is to show the charts, but also to provide some context. I mean, the administration is clearly, and they've not made a secret of this, accepting some short-term pain for the expectation or the opportunity for long-term gain. I think that long-term, sort of utopian vision that we have is not as clear as some would tell you. I think there are a lot of things that would need to happen between now and then to make that as successful as some are implying. But I think there's no denying from what we've seen today that the market is taking this as a big negative hit. I think the chances of a recessionary period probably exceptionally high. That means I'm happy remaining defensive until the charts tell me to not be defensive. For now, again, models that I track, tracking trends still negative, right? Nothing really has changed. While the news has changed, while the severity of the downtrend has changed, I don't think a lot has changed from yesterday to today in terms of the general technical structure of the markets. The NASDAQ composite, even worse, down 6%. Mid caps and small caps getting worse, 7%, 7.1% for the S&P 600 small cap index. So, higher beta, higher risk, higher growth, all bad places to be today. Again, we've sort of been talking about, not sort of, we've been very much talking about opportunities in value and defensive sectors. Defensive sectors outperformed just fine today. The VIX pushing above 30. That's kind of important, up 8.5 points today. And the VIX level over 30, a lot of my conversations with recent interviews have talked about, volatility, and whether that's going back to, Russell Rhodes, I want to say, who wrote the book on the VIX Trader's Handbook. I still have it over there from when I interviewed him a little bit ago. The VIX Trader's Handbook, talking about different ways of thinking volatility. Just a couple weeks ago, I spoke about volatility in general, just general volatility with Jay Soloff. Talked about the VIX term futures, VIX structures. And then with Craig Johnson in the podcast interview we released earlier this week, and many others, we've talked about volatility. Most people would tell you a VIX over 30 is usually not a good sign. Now, there have been times, and if you look the last time the VIX spiked up to these levels, it was at the July-August sell-off last year, which ended up being a pretty decent buy point. Granted, I would argue the environment we're in right now, very different than what we were in September of last year in so many ways, right? I don't have to outline them. I think we've been covering them pretty closely. But I would say this feels more like volatility warning, right? A volatility spike of this magnitude, given the building uncertainty that we have, given the breakdowns that we've seen, given the weaker breadth conditions, et cetera, et cetera, et cetera. I think this really announces more of a 2022 type of environment. I don't know if that's the exact playbook to follow, but certainly suggests further downside by my read. Bonds rallied today. The TLT was up only about 0.5%. That's not a huge up day for the bond markets, and it spiked earlier right out of the open, but really didn't continue higher. So stocks kind of dribbled lower into the close. It was just this whimpering market going into 4 p.m. Eastern. Bonds weren't really rallying at the same time. So sort of that initial rally in bonds, but then they started to sort of sell off as well. So rates did come down a bit today, but not as much as you might expect. The 10-year yield's around 4.05%. 5-year point around 3.75%. The long bond yield just below 4.5%. So we're coming down in rates for sure. And the chart of the 10-year yield, which I did grab, you can see how that's continuing to rotate lower. I mean, a day like this, just a great reminder that stocks over bonds, which has been the story for so long, maybe not the story, at least for the foreseeable future. The dollar index pulling back as well. Again, a big drop in the dollar right out of the open, and then just generally remaining fairly weak, although it did come back a bit going into the afternoon. U.S. markets have been underperforming non-U.S. markets year to date. I would expect that trend to continue in an excessive way, given what we've learned. I mean, the reality is, the general idea of non-U.S. investors investing in the U.S. I think that probably changes pretty big in a pretty big way. You're seeing that reflected in the dollar weakness. You're seeing that reflected on a day like today, where other markets were down, but the U.S. market down a lot more during U.S. trading hours. We'll see that in one of the many charts I'll try to get to here. Gold actually finished slightly lower. The GLD was down 0.6%. It did spike above yesterday's close around an hour and a half into trading, but by the afternoon was back below zero. So only down 0.6%. Again, gold, still one of the strongest charts I could show you in terms of major asset classes. Silver down quite a bit, and I would encourage you to listen to the interview with Miss Schneider of Market Gauge. We just released that yesterday, I want to say, talking about gold, and she actually offered up silver. We talked about the silver to gold ratio. Silver leading the way lower, down about 6%. Copper prices down almost 5%. Crude oil prices going lower. Most of the commodities we track here using ETFs down. Bitcoin came off. Now, Bitcoin, what's interesting is Bitcoin, you can actually track cryptocurrencies, in the after hours yesterday. So when the announcements are being made, when Trump's doing the lecture from the announcement, from the Rose Garden yesterday after the U.S. Equity close, cryptocurrencies real time. So you could watch the S&P futures, NASDAQ futures. You could watch cryptocurrencies. They all kind of rolled over pretty aggressively as I think the news was announced and investors kind of realized what the impacts might be. So during the equity session, actually, Bitcoin kind of came up a little bit and rallied into in the last couple hours here. Currently, Bitcoin's sitting around 82,500. Ether prices around 1,800. Those don't look as negative as you think because they actually sold off quite a bit after the U.S. Equity closed yesterday. So this is like after the close, and they kind of rolled over. Then the 24-hour session stops because they just basically take a point every 24 hours and consider that the close for Bitcoin. So these look kind of mildly green, but if you think about where they're at relative to the equity close yesterday, it's about as bad as you would imagine. Looking at the 11 S&P sectors, I mean, great to note on a day like today. I know it felt like everything was down today, and to be clear, a lot of things certainly were, but consumer staples were up 0.6%. The XLP actually had an up day today. Utilities were down, but not nearly that much, right? Down 0.6%. Healthcare down 0.8%. Big gap lower to real estate, even bigger gap lower to communication services, all the way down to energy down almost 8% today. So defensive areas in the market that we would traditionally try to hide out in a period of market instability, kind of fulfilling their expected role. It doesn't feel great to lose 0.6%. I'd much rather gain more, but losing 0.6% instead of losing 6%, that's better. So this is why relative strength is going to really start to accelerate, most likely even more on these defensive sectors, because these are the types of areas of the market that will thrive because they're perceived as stable, sort of economic, free from the economic forces. So even if things get really bad, we're still going to buy toilet paper and beverages, and we're still going to go to the grocery, and we're still going to buy cleaning products and things like that. Those are kind of the last things you would stop getting. You might not take that big trip all of a sudden, or buy a new watch, but you're still going to buy Clorox, right? And so that's why consumer staples, utilities, healthcare, these are sort of basic human necessity types of things that tends to be an area of the market that will do well. Investors know this, so institutions that have to be in stocks will get to these defensive areas as quickly as they can. We've seen that rotation happening. We've been covering the improvement in defensive sectors. I'll show you how that chart has just continued the trend that we've observed for a little while here. So the pain is really in some of these main sectors, and it's worth noting that 7 out of the 11 S&P sectors were down 4.5%+ today. So to be clear, this is a pretty rough day for a lot of stocks. The breadth was very negative, as you'll see in a minute. Technology, one of the key growth areas, consumer discretionary, both down 6 to 7%. So, again, these are not sectors that have been doing particularly well up until today, but certainly not feeling the love here. Looking at the breadth conditions, you can see they were colossally bad, is how I would describe it. The S&P 500, 81% down versus 19% up. The New York Stock Exchange, 86% down, 13% up. These aren't. They're pretty bad. I'll be honest with you. They're not great. 90% down days are kind of the general thing you're looking for. It's worth noting the mid cap and small cap indexes did actually get over 90% down. The kicker is that usually only happens in a big bearish phase, right? That's not a buy signal in my experience. That's the kind of market where it tells you that so many things are really rotating lower. It usually only happens at a big period of distribution. When we're in a period of distribution, you look for big 90% up days, which imply that maybe a bunch of people are starting to buy into weakness. We saw some of that strong breadth going into this little bounce up to the 200-day, but obviously not enough to really follow through to the upside. So the breadth was down. Again, even in the S&P 500, almost 20% of the S&P members were up today. And that doesn't mean that the markets aren't bad. It doesn't mean the benchmarks aren't bearish, which I think they very clearly are, but does tell you areas of the market are actually doing okay. And this is, I love having a dashboard where at least you can just see which stocks were up. Some names were actually up quite a bit today. So focusing on those areas of the market demonstrating strength when it feels like everything's going lower is a tried and true way of surviving a market like this. All right, looking at the Magnificent Seven and Friends, a lot of red here. You can see Netflix, which again has been the best of these stocks year to date, continuing to be the best on a rough day like today. Only down 2%. That's not bad. The chart of Netflix is not a bad chart yet. It's an okay chart, right? I mean, it's sort of consolidating in that coil pattern. But something to keep an eye on. Microsoft down 2.4%, Alphabet down 4%. Then we get to some really ugly returns. Broadcom, which was one of those and again, I'm so sorry to the good people at Broadcom. I added you to this list of leading growth names, and literally, I think that was the peak in Broadcom, just kind of rotated lower from that moment on. So down another 10.5% today. Apple down 9.25%. These are names, obviously, these big, technology internet conglomerates have done quite well, and that growth has been fueled from non-U.S. things, non-U.S. Products, non-U.S. Materials, and all of that. And so, companies like this that really their growth was driven by an easy way of accessing capital and consumers and a workforce outside the U.S. getting dinged. And again, the argument I've heard about why tariffs can be so good is that U.S. manufacturing charges back up. Companies that operate just in the U.S. You don't have to deal with tariffs, and so it's an incentive to do it. That logic of that makes sense to me. That is a long-term play, and in the short term, there's no way that that's not painful, because it's not like a company like Amazon can just pivot their entire business and operate in the U.S. There's no way that Apple can just replace a bunch of things they've been getting outside the U.S. and just automatically switch like that. That is a big process, and that process is going to be an expensive one for the companies. Unfortunately, it's going to be an expensive one for consumers as well. I don't see that how that doesn't make prices, things more expensive, at least for the foreseeable future. And that's why these stocks are down pretty aggressively. It's a classic kind of short-term pain for long-term gain is the argument. I think the long-term gain is the logic is there, but there are a lot of things that I think we don't really know about. It's sort of like restarting an engine that's been running for 10 years. Like I theoretically that should work, but we'll see what happens when we actually try it. All right, let's go on to the market carpet, and I will hopefully you can tell. I mean, in a day like today, you got to keep a good attitude, or man, it's brutal. All right, let's look at the market carpet. I do see some questions coming in. I appreciate it. If you have questions, I will do my best with the time we have today to try to give you some answers. I don't know how many answers I will have because again, we're all sort of processing what these tariffs mean. I mean, the market is telling you what it thinks about these tariffs, at least in the short term, is things are going down. So obviously a big distribution day. This is, the worst day we've seen for stocks like Apple probably since 2022. I haven't looked at the details on that, but that would be my guess. Those are when you have those big distribution days before. And before that, probably COVID sort of sell-offs, but it's been quite a while. So obviously quite a lot of pain here. And you can see in a sector like technology, I mean, just big red boxes. And again, I don't, if you own technology at this point, you hopefully have accepted before today the fact that this is most likely going to happen, and you're accepting that downside for the opportunity for longer term upside. Personally, I'd rather get out of the way and find a better time to buy back into names like Nvidia. I mean, I think Nvidia is a good company that eventually will do quite well, but not today. So having said that, a lot of red. I think you can see where all of that is. I would like to focus on things that are actually not going down. And if you look for the color green, you'll find it, right? It's not the most common color, but it is there. Now, think about where those areas are. I mean, obviously in the upper right corner with consumer staples, bottom right with utilities, some of the more defensive areas of telecom, things like AT&T and T and Verizon up today. In financials, right? Progressive and insurance companies, CME, these are names we've talked about on the show that are, that again are in uptrends that show you. I mean, up until today, I don't think that's a surprise, hopefully, that some of these names are doing well because these are defensive areas of the market that probably would do well given what's happening in the world. And so this is a like a growth bear market, but certain things are kind of doing okay. So consumer staples, honestly, if you scan for stocks with constructive technical configurations, I think you'll find a lot of consumer staples. I think you'll find a decent amount of healthcare. Look at UNH and J&J up 3-ish% today. And others like Molina, like Core. We actually highlighted that earlier this week, I want to say, on the show. McKesson, these are decent charts, right? In uptrends and doing okay or starting to recover for sure. In the technology sector, I mean, not much. And I think the problem now is technology is going to be a tough place to be. The only things that are randomly doing well, like Intel, which is like the most non-technology chart in tech, it just looks like a different chart in so many ways, did not participate in the big, AI-fueled uptrend like a lot of the other semiconductors. So things that were not doing well, starting to do well. First Solar actually having a bounce today, up about 5%. So they're out there. But again, growth sectors generally not where I would be focusing on ideas. And then finally would be utilities, right? I mean, and utilities and the old telecoms, these are defensive sectors, low volatility, higher dividend, higher relative strength. And I wrote an article for stockcharts.com. I think it's posted, so I'll show it to you. Please check it out. A couple ideas to share with you. But basically 3 defensive plays for post-tariff survival. And basically, I mean, it's 2 consumer staples names, and it's looking at utilities. And just the general idea here is you're looking at, besides just things going up, you're looking for improving relative strength. That's most important. And that's this data series that you would see on the bottom of any of the charts that I would bring up for you. The second thing would be positive technical configuration, price above moving averages, price actually in an uptrend, higher lows would be most important. What's common with a lot of these breakdown names is that they're making lower lows and lower highs. So look for stocks not doing that. And look for stocks with positive momentum. Scan for stocks with an RSI above 60 right now. There's not going to be as many of them, but they're going to be charts that are actually working pretty well. All right, let's go through the charts here. We'll get through as many as we can and then try to get to a couple questions. And then I'm going to go take a birthday break. And I hope you all have a way to take some deep cleansing breaths and recover from a market turmoil kind of day. So where does this leave us with the S&P 500? We've been talking about 5,500 as a level of support. We highlighted that level, back here when we're looking at the breakdown from the February peak. Talk about 5,850 as initial line in the sand. 5,500 is the next downside objective. As that became closer and closer, if that doesn't hold, we go further. And our downside objective is kind of in this 5,100 to 5,150 range. I'll show you the next chart that explains why I'm getting to that target. And I am planning to do a YouTube video probably later today or tomorrow morning, really going in a little more detail through, coming up with a new downside objective and some different things to look for. So look for that here very soon. But I would say today we break below 5,500. Now, someone had already mentioned in the questions, does that become resistance? Absolutely. We talked back here when 5,850 was broken. All right, we're now in a downtrend. That becomes resistance. When we break the 200-day, clearly it's all right. That's now broken. That becomes resistance. That's what prepares us for this kind of move, which is a counter trend rally to the previous support level, which now becomes resistance. I would say now you kind of have a similar setup most likely happening. S&P back over 5,500 probably changes things. You have to reconsider and reevaluate. But for now, I would say, downtrend with 5,500 as the upside level to think about. So for me, that means we go further. The momentum has been negative, right? The RSI broke below 50 here, third week in February, has remained below 50 from that point on. That's one of the many things kind of telling us this is a counter trend rally and not one to get sucked into. And again, these kind of rallies, I don't blame you if you're drawn into that as a swing trade, great opportunity. But as a longer term investor, I heard plenty of people talking about this is the low is in, let's buy into the dips. I think the reality is counter trend rallies big rallies are often most exaggerated during bear markets. That's when you get these big upside swings. It feels like everyone gets drawn in. They're sudden, severe, and seductive. They come out of nowhere, right? We're making a new low, and then all of a sudden we have this big dramatic pop. They're severe, right? They don't just kind of gently roll higher. They just V bottom, just pop right off the lows. And they're seductive, right? They very quickly, it feels like everything's up. Your monitor shows all green. It feels like, okay, this is it. That's the low. That's the bottom. And I feel like we're so confident or optimistic or hopeful that we're able to call the bottom. And so we sort of take a bet. And that's why I avoid these kind of things until we get more confirmation. So for now, again, I think this just continues to confirm this downtrend phase that we're in. So where do we go next? Here's sort of my initial look, and then I'll do some more work and hopefully push this out as another YouTube video later today, probably tomorrow morning when I can get my head around everything here. This is a daily chart of the S&P 500 going back to the 2022 low. So when you break down through support, right, when you have like a clear idea and then it's broken, I think what the market's telling you is, okay, you got to reset your thinking, sort of recalibrate, reevaluate the conditions. When in doubt, zoom out, bring in more data, and just sort of make sense. All right, now that we're in a new regime of some sort, what can help me sort of get a framework to work with? So when you zoom out to the 2022 low, and then you think of this as a big uptrend from October of 2022 to the eventual high in February of 2025, now we can start to think about broader support levels. Instead of just these little pullbacks along the way, focus on the big pullbacks, right? The July-August low, a big one. The April 24 low, kind of a meaningful one. The October 23 low, super important. The October 22 low, right? These are like the big ones that stick out. I mean, just visually, you can see those are the major lows where something changed, right? Something was happening and then something changed and the market sort of rotated, a key inflection point. So if we take that 22 low to the 25 high, 38.2% of the way down gets you an objective right around 51.30. That lines up remarkably well from the low from last summer, which was in early August of 2024. The actual low is around 51.25. So we have 51.25, 51.30. Then the other thing you can do is use this bear flag pattern as a midpoint of the trend. And I showed this, previously, and I think shared it on the show. A couple different ways you can measure this. To be honest with you, the technical analysis literature has some mixed advice on how to actually measure these moves. Some would say, take the beginning of the breakdown and then take it to the lower end, that low right there. I actually do I tend to simplify as much as possible because targets are not a huge part of my process, but there's something to work from. So I like it. So what I do is I basically take the peak and take it to the beginning of the flag pattern. And then I take that exact move and project it down from the breakdown. And the different measuring techniques will all give you a target down in kind of the 50 to 5,200 range, depending on how you measure it and which levels you use and which level you use as a breakdown. But for me, they all kind of come down to this level. And not surprisingly, they're not far off from that Fibonacci level and from the August 24 low. So I'm kind of seeing this 5,100 to 5,200 range. That's my general thought of where this probably goes. The reason why I'm happy having a target above that is because this is a minimum downside objective. What this flag pattern basically says is, given where the flag happened, you usually have an equal distance on the what's called the flagpole, the trend going into the flag. You have a similar trend coming out of it, which says we go at least to 5,200 if that bear flag pattern follows its normal trajectory. So that for me means 5,100 to 5,200. If and when we get down to that level, I would absolutely start be thinking as a buyer and be looking for opportunities. There will be other levels we'll think about if that really starts to break. But generally, that has often been a really good place to think about accumulating, at least taking some speculative bet that a bear market phase is over. But given what we've seen and given what's happened here today, I think that's a reasonable downside objective. It's getting closer by the day with how today's sell-off actually played off. All right, let's look at some other charts here. And I would say the S&P 500 breadth data, obviously pretty weak today. We mentioned the breadth earlier. As of today's close, we're down to around 38% of S&P stocks above the 200-day, down to around 32% above their 50-day moving average. This indicator is important to watch now that we're in sort of a bearish phase. Look for when this breaks above 50%. It'll happen at some point, and that often would happen after a major low, but it would confirm that that thing that just happened was probably a pretty important low. So at that point, if you're not kind of re-engaged, that's a great sort of alert to say, all right, most stocks are now back above the 200-day. This could be a broader recovery. So that's something to watch as well. The NASDAQ bullish percent index, just like that, in a couple of days has gotten back down to oversold conditions. I mean, I have to tell you, this is where I usually look for short-term buying opportunities when the indicator gets below 30%. This means 70% of the NASDAQ 100 members are in a bearish point and figure structure right now. I'm super hesitant to be taking some speculative position in a growth stock right about now, but we'll keep tracking this. And it could be just a counter trend bounce before another leg lower, but as a swing trader, these are the kind of things that often identify some of the short-term upside swings. So we'll continue to monitor that. It did break below 30% today. Last time it was below 30%, second week in March. That was just before this counter trend bounce on the NASDAQ composite. The S&P, of course, bouncing up to its 200-day moving average during that period. Here's the VIX pushing up 30. I feel like I need to start bringing in some more data, which I probably will do starting tomorrow. But generally, VIX above 30, at or above 30 is basically you're now in a very high volatility environment. Studies that I've seen looking at the average forward-looking returns when the VIX gets above 30, it's not good. And it basically says that's when we're in a bear market. It's not a timing tool. It's not necessarily telling you when. I think once we're in that pattern, we have to look at other indicators to sort of identify a meaningful low. But it's worth noting that the VIX has now gotten to the point well above 20, now pushing 30, where studies that I've seen, particularly from Ned Davis Research, which I used to follow quite often, suggest that this is where forward-looking returns are not as positive over the next 3 to 6 months for sure. Survey data came out. Now it's worth noting these surveys usually are locked in like Wednesday afternoon and then reported Thursday morning, Thursday midday. And so I don't know how much of today's sell-off, probably not really reflected in this data, I would say, at all. But the AAII survey did come in back more negative. Last week, if you remember, there was a pretty decent spike in the AAII survey, up to around 28%, I think, bulls, or getting close to 30%, down to around 50% bears. As of today, we're back to 62% bears, which is literally the highest reading we've seen in the last 5 years. Before you get too excited, just remember in protracted bear markets, you can get really negative sentiment data that just kind of stays there. So I don't think of this as much as a timing tool, but more descriptive about investor psychology. Tells me we're in a bearish phase to look for opportunities of a bottom, but not seeing them here yet today. The name exposure index continuing to get lower and lower over the last 7 weeks now straight. We've seen a decrease in the name exposure index. This is a group of money managers reporting on their allocation to the equity space, down below 50%. Last time we were down this low, it's been a while. October of 2023, that was the last time. But you can see on some of these sell-off periods, we'll dip well below 50%. 50% is right around here. So like in February of 2022, we're going below 50%, obviously before a much more protracted decline. So definitely getting down to bear market readings on some of that sentiment data. Now, bond markets did not rally as much as you might think, as much as a lot of people think of bonds as a safe haven in a period like this. Not necessarily. I think it's important to follow the charts and see what sort of safe havens emerge. The 10-year yield did go down today. The 10-year yield $TNX has a hammer candle today, which is where you have the open and close near the highs of the day, a long lower shadow, no upper shadow, suggest a short-term bounce in rates here tomorrow into Monday. But I would say generally rates in a downward trend below this trend line resistance. So I would say generally higher bond prices, weaker yields are the general trend that I'm observing here. We highlighted the yield curve getting back inverted. I would not be surprised if that inversion continues here as bond prices rally. A couple of ratio charts to highlight for you. And again, if you're trying to get your head around what's going on here, besides just analyzing and trying as much as possible to just use classic technical approaches and just analyzing the chart, let the chart stand on its own. look at ratio charts, which help you relate different asset classes. Here we're looking at stocks using the SPY versus bonds using the TLT. The stock to bond ratio, as we reported earlier this week, breaking below the 200-day moving average. The last time we did this was back last summer, early fall, when we broke below it before rallying back above there. This week really appears like we're accelerating down here. It's been a long time since we've had an extended period where stocks are underperforming bonds. Even in 2022, through the course of the year, stocks still actually outperform bonds because they were both going down. Now we're actually seeing a situation where bonds actually do represent a better technical setup for now, and that ratio is certainly reflecting that. Here's U.S. versus non-U.S. markets, and this is actually U.S. versus global markets. So SPY versus ACWI, which is All Country World U.S., All Country World Index. I apologize. Another one you can do is ACWX, which is All Country World ex-US. Either way, the ratio kind of has the same general trend. It's been going lower year to date after making a peak in December. Now, why are U.S. markets underperforming? Two main reasons, and that's, again, has nothing to do with yesterday. I think yesterday is just the latest piece of evidence telling you U.S. is underperforming, and being in non-U.S. markets is probably an interesting place to be. Number one, it's the leadership here, right? When it's mega cap growth leading, and when it's technology and AI, that is a U.S. dominated theme, at least for now. So that's been where the bulk of the gains have happened. Now, other charts like Taiwan Semiconductor benefiting from that as well, but generally that's our U.S. benchmarks are heavily weighted to those themes, much more so than European and Asian benchmarks. So U.S. SPY is going to do better than ACWI in that environment. When those themes are not working, when those are underperforming, and it's other things that are doing well, the U.S. is probably going to underperform. And that's been that leadership rotation that we've talked about. But the real story is the weaker dollar. You can see generally when the U.S. dollar is increasing, U.S. markets tend to underperform. When the dollar is weakening, U.S. markets tend to underperform. This kind of captures a number of things, but our international non-U.S. investors converting to dollars to buy U.S. assets. That's not the vibe I'm getting from the chart here in 2025. Based on what we heard yesterday, that certainly seems to be a trend that's probably going to continue, which means non-U.S. markets probably in a much better technical structure on a relative basis than the U.S. until proven otherwise. We'll keep an eye on that chart. All right, some individual stocks, and then we'll take a question or two. Hey, let's start with the chart making new 52-week highs today. They're out there. Kroger, right? Groceries. And this is a reminder. I think this was an Alan Shaw thing. Alan was a longtime technical analyst at Smith Barney, eventually the Citigroup, and Louise Yamada, and who else was in that group? Oh man, I should be able to come up with these off the top of my head. Ron Dano and Jonathan Lynn all worked with Alan Shaw at Smith Barney into Citigroup. And eventually now most of them have retired, but had a chance to meet Alan a number of times before he passed away. And I think he used to say, like, things you eat, things you drink, things you would use to. I forget what he had a great phrase that I'll try to find. I'll ask Louise if she remembers it, but he had something that he would say, which was basically like buy consumer staples in this kind of environment. And again, Kroger just completely bucking the longer trend. This is a chart making higher highs and higher lows. The relative strength is improving, and not just this week. This has been going on for a while, right? We highlighted Kroger as one of the top 10 charts to watch for April 2025. We recorded that on Monday, Grayson Rose and I. Kroger was one of my picks because I was like, this is a stock just in an uptrend, and stocks in clear uptrends above two upward sloping moving averages when it feels like the world's ending. Those are great charts. I mean, fantastic charts. In 2024, these charts are pretty common. It feels like everything looks like this, right? Remember when Warner Brothers Discovery was like a huge outlier because it wasn't above its 200-day moving average, and now it's like hard to find charts like this, but they're out there. Scan for stocks making, with above upward trending moving averages. You'll find charts like Kroger. It's a defensive play. It's a grocery store, but it's worked quite well, really going back to mid-2024, and there's no pause in that trend that I'm seeing. Higher highs and higher lows is an uptrend. The charts are out there, so look for them. Now, this is a chart which shows you why charts like Kroger are even more compelling. because consumer staples are outperforming consumer discretionary. In this sort of pattern, when the ratios are going higher, that means consumer discretionary, things you want, are outperforming consumer staples, things you need, right? In the downtrend that we see in this ratio from mid January, late or early February through this week is the more defensive side of the market is outperforming. This is a ratio that was derived from conversations I had with Bill Doan, who ran the Fidelity Technical Research team in the 1970s, and he talked about a analysis they would do on offense versus defense. They had some different indexes they used to try to back into that. XLY to XLP is a decent way to do it. I like using the equal weighted version, which is the RSPD versus RSPS. These are two equal weighted ETFs that track these consumer sectors. And basically, you can see both of these have been trending down fairly consistently since the February market peak. So, just being an exaggerated downtrend with today's drop in the XLY. But overall, again, the trend has been favoring defensive sectors for quite some time. We can also look at the defensive sectors individually. Here's the XLU, utilities, the XLV, healthcare. This is the XLP, consumer staples. This is the XLRE, real estate. All four of these sectors outperforming the S&P 500 year to date. This is why we use the RRG, the relative rotation graph. It's highlighting value in defensive sectors here for a little while. This is why we look at the relative strength ratios, just to focus on things where the relative strength line is going up. Technology does not look like this. It looks like this flipped upside down, and it's been underperforming year to date. So these are the sectors. If you ask me, where can you hide out? Where can you find opportunities? These are the four sectors I would be focusing in on primarily because they're defensive sectors. They tend to be lower volatility, which means lower pain, less pain if they go down, because they'll probably go down less than the benchmarks. And they tend to have a higher income component because they pay a dividend. And so those are good opportunities. Now, some of these charts we've been highlighting, question at the beginning of the week, does Meta hold its 200-day moving average? I don't know if after today, I would say that is a likely outcome because you'd have to have a big 10+% rally tomorrow. Probably not what we're going to see. I would say tomorrow after today's big puke out Thursday, Friday is going to be kind of like a choppy sideways day would be my guess. Again, I don't know, but that would be my general guess is you probably have a digestion day. We kind of lick our wounds and maybe some of these things bounce up a little bit when some really optimistic people think Meta is a great deal at 531. I don't think that's sustainable. I still think there's more to go on the downside, but after a huge down day like today, probably a bit of a bounce would be the kind of general assumption after this sort of heavy volume deterioration. But I would say Meta most likely finishes below its 200-day moving average. That's not good. Amazon really struggling over the last couple weeks to get back above the 200-day. It does not look like a likely outcome. Tesla, though, down 5.5%. But listen, today's range was within yesterday's range. This is an inside day, right? We had a lower range today than we did yesterday. So even with a lot of things going down, names like Tesla that actually didn't undercut yesterday's low. Kind of interesting. I don't know if Tesla's my favorite chart right now, but it's not going down at the moment. It's actually still consolidating. Still consolidating means you're outperforming in a time when the markets are down. So looking at the 200-day still in play, I would say for Tesla, not the case for Apple and others, obviously accelerating to the downside. A chart like this is not a chart I would be taking a look at in any serious capacity. We are nearing the 61.8% level. We are nearing a big round number of 200. A bounce off of that level would make a ton of sense to me from a technical perspective. Is that enough for me to say that's the bottom? 100% no. Let's see. Finish off with one other chart going higher. I tried to bookend the Magnificent Seven with Kroger, and then I'll give you Molina Healthcare. Those are your nice charts sort of surrounding some ugly ones in the middle. But MOH, an uptrend. And so I would say, in charts like Apple and others, you take the highs and draw a trend line off the peaks. That's how you track that downtrend and maybe identify some way of validating that the downtrend is over. Not happening yet. Same thing with something like MOH. This is an uptrend of higher highs and higher lows. I can draw a trend line off of those recent lows. As long as we remain above that trend line support, the uptrend's probably in pretty good shape. So again, focus, I would encourage you, look for things above the moving averages. Look for things with improving relative strength. Those are areas of the market doing well. They're out there. It's just not in the names that you probably know or that you readily have at the top of your head. Use scanning tools, use alerts to identify some of those opportunities. I hope that was a helpful 45-minute diatribe on what we learned from from the markets today. Again, I mean, if you detect the fact that I'm not that broken up about it, I mean, the benefits of doing this for long enough is you've seen big down days, you've seen down years, you've seen bear markets. We've recovered from every bear market that I've experienced, but I've honestly learned more about investing in bear markets than I have in bull markets, and it's not even close. I mean, you learn a lot more about risk management, about scanning for ideas, about idea generation, about position sizing and risk in bear markets, because that's when it really hurts you, when you don't have those things locked down. So I hope you're able to use this as a learning opportunity. Our market misbehavior premium memberships could be a good way to supercharge that, by the way, if you need help. Let me take a question or two here, and then we'll wrap it up here. Roha, thank you so much for watching on YouTube. You said Carterworth sees downside of 48.50. Thoughts? Yeah, I know Carter well. He's a fellow CNBC contributor. He's on CNBC way more than I ever hope to be, and that's awesome. Downside objective. I really I miss Carter's quarterly visits to Boston when I was at Fidelity. It was awesome to sit down with him, for sure. Let me take a look. I mean, 48.50. So here, what happens, right? I mean, in this sort of environment, when you've had the move that we've had, everyone's going to sort of give you their objective and sort of a downside projection. I'll try to look at what Carter was talking about with 48.50. I don't know what he was using to derive those levels. I'll save a judgment on that until I can see it. All I will tell you is none of us know for sure where the market is going to bottom out. Let's set that up right up top. And I'm sure some will guarantee they have an idea. None of us know. We're making educated guesses based on some framework. For me, I'm using Fibonacci retracements. I'm using previous lows. I'm using that to identify where I would expect major support. I'm sure Carter is using some other techniques to kind of come to the similar conclusion. But what I would tell you is the market's going to bottom out at some point. And I don't think a downside target is the way that you can consistently identify that. I think tracking the trend, looking for what happens when we get to this point, looking for what happens if and when we get down to that point, that's the more important question to answer, right? Is analyzing the trends as we get to those points. Use the market bottom checklist, which I'm now thinking I'm going to have to dust off at some point. I don't think I'm ready to do it yet, but at some point, and we'll go with it. But I'll take a look and see what I can find about Carter's objectives. Maybe shoot him an email and share with you what I can. Marty, thanks so much for watching on YouTube. Marnie, excuse me. Hi, Dave. Would you mind commenting on CBOE? Both their chart and why in this climate they continue to do okay. It's so interesting. I almost feel like in this sort of environment, you almost like you want to grab a side and be like, what? Like, why do you deserve to be going up right now? Everything's going down. Like, what's so special about you, CBOE? I feel like that's something that you could think. It's interesting. I would go back to my conversation with Jay Woods. I interviewed him on the Market Misbehavior podcast a couple weeks ago. Jay talked about exchanges, and we were talking, I mean, before today, right? We're talking a couple weeks ago about where we're still seeing strength despite the weakness in mega cap growth. He highlighted in the financial sector, particularly, it's like not the banks. It's things like insurance companies like Pru and others. It's exchanges, things like CBOE. Why is an exchange like this, or why is CBOE going up? I mean, I'm not a fundamental analyst. I can't tell you specifics about their growth prospects. I will tell you a logical reason why it would make sense to me. Charts like this trade very different from the financial sector because it's not a bank. This is an exchange. And to be honest with you, most exchanges are, exchanges, but they're really market data providers. I mean, their business is selling data. So a lot of times when you bring up a website and bring up the S&P 500 or some, future or something, the CBOE is getting some fee for you to be able to show that information from someone. And so I would say their business is on market data. During periods of market choppiness, particularly when banks are doing pretty well and making a lot of money with trading and their brokerage departments, they need a lot of data, and hedge funds need a ton of data, and they're all going to places like the CBOE and ICE and others. And so I'm not surprised that these charts kind of look pretty decent in this environment. Because when financial companies are struggling to get their head around it, when they're trying to make money through investing, they have to go to places like this. This is the raw data. These are the raw materials that you use to develop an investment strategy or an investment process. So these are market data providers. They traffic in financial data. The business for financial data is pretty good. And banks are actually doing pretty well right about now if you look at their most recent earnings. And so that means exchanges that cater to those big institutions are doing pretty well as well. That's my non-fundamental but general approach as to why those kind of names do pretty well. And again, I would look for some of the FactSet, not as much. I'm trying to think of other. These are, this is not an exchange; it's more like an analytical tool. FactSet is a product that a lot of buy-side firms would use to analyze companies and sectors. But that's why some of those names might be doing particularly well in this environment. One more question. Makafui, I will say, I apologize if I mispronounced that. What is the name of the data presentation course that you were recommended when you were at Fidelity? I don't know where you got that from. And I have mentioned that. Maybe I mentioned it on the show or in a presentation. I'm so glad that you asked me about it. It is an Ed Tufte class, Tufte. I'll put a link in the description or in the show notes for his books. The book that I remember off the top of my head is called Beautiful Evidence. When I was at Fidelity in the chart room, it was like required that all of us would go to a day-long presentation, and he would come through a city like Boston and literally talk about presenting data. I wish everyone went through that course. I wish they would read Ed Tufte's books, because it's all about how to make the evidence beautiful. And when you're thinking about charts, it's a way of visually telling a story about the markets. It's what you're doing. It's trying to illuminate the markets through visualization. And I see a lot of sloppy charts out there, and it makes me cringe, because we would always say when we would create a chart for the Fidelity chart room, is it Tufte friendly? We would say, is it a Tufte friendly chart? Meaning, did it check all the boxes? And it's everything from what colors you use, what shapes you use, what evidence you show. Do you use grid lines or not? Where do you put labels? All of that should be intentional. And I learned so much from learning from Edward Tufte and from others that followed him. So I'll put links in the description for his work, which I think is absolutely fantastic. Folks, thank you so much for joining me here on the show. I hope I'm able to help you navigate these markets. I'm doing the best I can to help you make sense of things. But no matter what happened to your portfolio today, I wish you well. I wish you peace and joy today and always. I'm Dave Keller with Market Misbehavior. Remember, it's always a good time to own good charts. Have a good night.